Welcome to your deep dive. Today, we're really zeroing in on FinWise Bancorp. They dropped their Q3 2025 results after hours back on October 29th.
Yeah, and the market definitely noticed the next day. It felt like more than just another earnings report. This was significant.
A profound surprise, you could say. A turning point.
I think so, yeah. The results themselves were strong, really robust, but it was more about the market finally seeing, that the strategy is clicking.
The fintech program model delivering scale.
Exactly. Delivering actual scale and, maybe more importantly, real operating leverage. So today we're going to unpack what drove such a strong quarter.
Okay, let's do that. Starting with the main numbers, because this was a beat pretty much everywhere, right?
Oh, absolutely. A big one.
So GAAP EPS, earnings per share, landed at $0.34.
Right, and consensus was looking for $0.30.
Yeah.
So a solid 13% beat there.
Nice. But the real eye-popper seemed to be the revenue, wasn't it?
That's where things got really exciting. Total net revenue, that's your net interest income plus non-interest income, came in around $36.7 million.
And the street was expecting.
Way lower, about $27.9 million.
Wow, okay. That's a 32% surprise on the top line? No wonder the stock moved.
Precisely. And that massive revenue beat flows right into, I think, the most critical operational highlight for me this quarter.
Which is?
Efficiency. The efficiency ratio improved dramatically, came down to 47.6%.
Yeah, down
from 59.5% just last quarter in Q2.
Okay, quick reminder for everyone. Lower is better with efficiency ratio, right? It's costs relative to revenue.
Exactly. It tells you how many cents they spend to earn a dollar. So getting down below 48 cents, well, that shows serious operating leverage is finally kicking in, like really kicking in.
So the engine is scaling. Let's talk about that scale. Where did the growth come from?
Well, the raw numbers show it. Loan originations were really strong, $1.79 billion in the quarter.
And that pushed total assets up.
It did. For the first time ever, they ended the period with assets knocking on the door of $900 million.
Nearly $1 billion. That's a milestone.
It is. And that kind of balance sheet growth is what gets investors interested in a potential re-rating.
Right.
But it's how they're growing that matters.
You mean the credit-enhanced strategy?
That's the absolute core of it. That's the growth driver. We really need to understand how that works. Balances, they're hit $41 million at the end of Q3.
Growing fast.
Okay, hold on. Let's pause on risk. Assets growing fast, credit-enhanced balances growing fast. But I also see the provision for credit losses jumped. $12.8 million this quarter. Isn't that like a huge red flag?
That's exactly the right question. And it looks concerning on the surface, but this is where the structure is, well, frankly, quite clever.
How so?
That $12.8 million provision, it's directly tied to the growth in those balances. It's almost an accounting requirement of the growth itself.
Not necessarily tied to actual expected losses.
Not in the traditional sense, because these loans have part-in guarantees, contractual guarantees. So FinWise is structurally insulated from the primary credit risk.
Okay, so the guarantee offsets the provision. How does that show up on the P&L? It comes through as credit enhancement income. There was $18.1 million in non-interest income this quarter. It's basically like an immediate offset for that provision expense.
An insurance payout, almost.
Kind of, yeah.
Right.
And critically, they mentioned the partners have to keep cash loss reserves deposited at FinWise. So the guarantee isn't just paper, it's backed by cash.
Okay, that makes sense. So the net risk is actually pretty low, despite the high provision number.
Correct. And they're managing concentration, too. They mentioned internal limits, about 15% cap per program, not just per loan type. That diversification is key.
Got it. That really clarifies things. It's managed growth, not just reckless expansion. And the financial results of that growth are pretty stark. Net interest margin, NEM, that jumped significantly.
Huge jump. 9.01% for the quarter.
Up from what, 7.81% in Q2?
Yep. And that was mostly driven by adding more of those high-yield credit-enhanced loans to the books.
So the whole machine seems to be working better now. Scale, efficiency.
It really does. And even if you strip out those credit-enhanced items, to get a cleaner look at the core bank operations, the underlying health is still really good. Their non-GAAP core efficiency ratio improved, too. Went from 65.3% in Q2 down to 59.7%.
So even the basic blocking and tackling on expenses is getting better.
Exactly. It shows discipline. Management made a point of saying they're staying tight on comp and other operating costs. It's not just the fancy new strategy, it's also good old-fashioned cost control.
Okay, that paints a strong picture for Q3. But the market reaction wasn't just about Q3, was it? It was also about what's coming next.
Definitely. The announcements after the quarter ended were huge catalysts.
The new partnerships, let's touch on those. DreamFi.
Right, a fintech focused on underbanked communities. That's one.
And the other one, Tallied Technologies. That sounded quite significant.
Very significant. Tallied is a program manager, and they're launching 2 co-branded MasterCards. With FinWise, 1 consumer card, 1 business card.
And this Tallied deal hits the books soon.
Slated to close December 1st. And management gave some pretty punchy guidance around it.
Which was?
They expect Tallied alone to add $50 million in credit-enhanced balances just in Q4.
$50 million, just from that one deal in 1 month.
Yep. And that pushes their total Q4 end-of-period target for those balances up to about $115 million.
Wow, okay. Their old guidance was $50 to $100 million for year-end, wasn't it?
It was. So this blows past the high end of that previous range, shows a lot of confidence.
And looking out further into 2026?
The organic growth picture looks really solid, too. They said they're comfortable guiding to $8 million to $10 million per month in new organic credit-enhanced balances.
Per month. So baseline growth of roughly $100 million plus a year, even before any new big deals.
That seems to be the baseline expectation, yes. The existing engine is set to produce very predictable fast growth now.
Okay, it sounds almost too good to be true. Growth accelerating, efficiency improving. What are the potential bumps in the road? Management must have flagged some risks or nuances.
They did, and it's important we cover those. First, the NI.
Right. You mentioned it jumped to over 9% in Q3, but they warned about Q4.
Yeah, they suggested Q4 NAI might actually compress a bit relative to Q3.
Compress? With growth accelerating, how does that work?
It's about where the revenue gets booked. With the new Tallied card program, the income gets split.
Spill how?
Some comes in as net interest income, the traditional way, but a chunk comes in as interchange fees, which lands in non-interest income.
Ah, okay. So the total profit from the program is strong, but because less of it is technically interest income, the NIM calculation, which is NII divided by assets, looks lower.
You got it. It's a metric distortion, not necessarily an economic slowdown. The overall pie is bigger, but the slice labeled NII is proportionally smaller for that specific program's revenue. So NIM might dip short term, something for investors to watch and understand.
Good flag. What about credit quality? Any worries there beyond the provision accounting we discussed?
Well, Q3 was actually better than expected on NPLs and non-performing loans. Only $3 million moved to NPL status. They thought it might be $12 million.
So good news then.
Yes, but management was quick to say, don't get too comfortable. They expect some lumpiness. They're guiding for $10 million to $12 million of loans currently on the watch list to actually migrate to NPL in Q4.
Okay, so a pickup in problem loans is expected. But how risky is that, really?
Still relatively contained is the message. Because crucially, 54% of their current NPLs are government-guaranteed SBA loans. That's a big safety net.
Right. So connecting this with the wider world, regional banks generally are facing higher funding costs, right? But FinWise seems to be carving out a niche.
Definitely. They're leaning hard into this fintech partnership model, this program management angle.
Yeah.
It gives them a growth path that's maybe less sensitive to traditional deposit cost pressures.
That makes sense. It's their edge. But are there any macro risks specific to them?
Yes. One fairly significant short-term one they flagged, a potential federal government shutdown.
Ah, because of their SBA lending.
Exactly. A shutdown puts SBA loan approvals on hold, some closings get delayed, and importantly for fee income, it stops the secondary market sales of those guaranteed loan portions.
So a prolonged shutdown could actually hit their Q4 fee income numbers.
It could, yeah. It's a near-term risk to keep an eye on.
Okay, this has been a really thorough breakdown. We've covered the execution, the strategy, the acceleration, the risks. Great stuff. Now, before we wrap, the usual disclaimer. This is just us summarizing the call for information. It is absolutely not financial advice.
Definitely not financial advice. But for listeners who understand the risks and maybe like a bit of speculation, shall we pivot to a trade idea?
Let's hear it. Based on this accelerating story, what's the speculative pitch?
It's pretty straightforward directionally. Go long. The core idea, the thesis, is that the market still hasn't fully priced in how fast these new card programs, especially Tallied, could scale up.
So the bet is the street's models are too slow?
Essentially, yes. Under-modeling the speed of Tallied and underestimating the combined impact of Tallied and DreamFi on that $8 to $10 million monthly organic growth baseline for 2026.
And why is now the time? Why does the street need to catch up?
Well, look at the stock's performance year to date. It's up, sure, about 10.1% total return. But the regional bank ETF, KRE, is up closer to 14.8%.
So FinWise is lagging its peer group despite this accelerating story.
Exactly. There's catch-up potential baked if, and it's an if, that 2026 organic growth number starts hitting or exceeding the high end of that $10 million a month guidance. And remember, the card programs really start launching this month in November.
So the outrageous conclusion, the core bet is?
The bet is that the incredible operating leverage we saw in Q3, the 47.6% efficiency, is actually sustainable, even with some end noise near term. If they hold that efficiency while the balance sheet blows past $900 million, well, that should lead to a significant upside surprise in 2026 EPS that isn't in the numbers yet.
A powerful thesis. Okay, let's recap the key takeaways for you listening. We saw a clean beat on earnings per share.
A really sharp improvement in operating leverage, suggesting the business model has hit an inflection point on scale.
And clear, tangible catalysts ahead with the Tallied and DreamFi partnerships already driving guidance higher.
Right. And maybe one final provocative thought to leave you with.
Go on.
On the call, management was directly asked about finding more efficiencies down the line. They specifically mentioned they're actively analyzing the potential impact of AI.
AI in banking compliance and risk.
Exactly. Those areas are often heavy on headcount. So the question is, could AI unlock another layer of efficiency gains beyond what we saw in Q3? An unexpected upside lever for 2026 earnings, perhaps, that nobody's even thinking about yet.
Interesting. Something to definitely think about as these partnerships roll out. Okay, thanks for joining us for this deep dive into the FinWise earnings.
Keep listening. Keep learning.
We'll catch you on the next deep dive.